bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 26th, 2025 episode. My guest this week is Jason Watkins. Jason's a partner in Novogradac's Atlanta office and one of Novogradac's leading experts on the Opportunity Zones incentive. He leads Novogradac's Opportunity Zones working group and often speaks about Opportunity Zones at conferences and on other podcasts. Also, Jason will be co-hosting an Opportunity Zones webinar that we're going to air on Wednesday, the day after this podcast is posted. Now, this webinar is designed for people of all experience levels, including beginners, and regardless of an individual's experience level, I do encourage you to register for the webinar. I'll provide a link to the webinar in today's show notes. Now, Opportunity Zones have been a hot topic since they were made a permanent part of the tax code in the One Big Beautiful Bill Act that was signed into law July 4th. Of course, if you're involved in Opportunity Zones, and even if you aren't, you probably know that already. You probably also know that the new iteration of the Opportunity Zones incentive does include some changes from the existing Opportunity Zones incentive. One significant change is which census tracts are eligible to be nominated as Opportunity Zones in 2026. And those nominated zones, if approved by Treasury, would become investable at the beginning of 2027. We'll talk about that in more detail in today's podcast. I'm also excited to announce that Novogradac has a new mapping tool available that highlights the census tracts that are likely to be eligible to be nominated by governors of the various states to be Opportunity Zones. This mapping tool is already proving to be very, very popular. I'll also provide a link to that tool in today's show notes. Also, here at Novogradac, we track opportunity fund investment and we issue reports on our summaries of that collected data every 3 months. Our most recent report was for the period ending June 30th. And the funds that we track reported that they have raised more than $42 billion in equity since the Opportunity Zones incentive began. Now, more than $1 billion of that was reported raised during the second quarter of 2025. Jason will also discuss his insights on those recent reports. But first, we're going to talk about some of the changes to the Opportunity Zones incentive and what that may mean to developers, investors, businesses, and many, many others. Jason and I will also look ahead to what the next several months look like for Opportunity Zones, including starting next year, designation of new zones, as well as areas where we really need to get guidance from the Treasury Department and what we're hoping that guidance will say. We'll also talk a bit about the potential so-called dead zone in 2026. And if you don't know what that means, keep listening and you will. We'll wrap up our discussion, with a brief look at what our Opportunity Zones investment data shows about investment patterns. Now, one other reminder, we are holding our 2025 Opportunity Zones Summit this December in Las Vegas. It'll be held Wednesday, December 3rd. It is going to be a great celebration of the permanency of Opportunity Zones and a great way to kick off 2026 and the whole nomination process of future zones and deal with the end of the first measuring period or the deferral period of Opportunity Zones. Jason and I, of course, will both be there, so please attend and swing by and say hi. I'll share a link to that as well. Now, as you can tell by this introduction, Jason and I have a lot to discuss, so if you're ready, let's get started. Jason, welcome back to Tax Credit Tuesday, and I apologize for that lengthy introduction because I want to jump into what we're talking about.
No problem, Mike. I'm always excited to be a guest on Tax Credit Tuesday.
So this is your sixth appearance on Tax Credit Tuesday, with your most recent visit coming 6 weeks ago when you, Peter Lawrence, and Tony Grapponi joined me to talk about the One Big Beautiful Bill Act being signed into law. But before we go into the more detailed discussion today, please describe some of the services that you provide to your Novogradac clients.
Sure. I provide audit tax compliance and consulting services to all of my clients, and with a particular focus on opportunity zones. As you noted earlier, I do lead the Novogradac Opportunity Zones Working Group. It's a great collection of stakeholders in the OZ industry. We work together to brainstorm solutions to technical issues that have arisen, a lot of questions there. And we also look to make recommendations to both Congress for Opportunity Zones 2.0, as well as to Treasury for regulations that are going to be necessary to make sure that the OZ 2.0 rollout is as effective as possible.
Yeah, thank you for that. And thank you for all the work that you do for the Opportunity Zones Working Group and the thought leadership that you provide. When I tested in front of the Senate Finance Committee last year, a lot of your work and your thought leadership made its way into my testimony. So I appreciate that. So thinking about the One Big Beautiful Bill Act and Opportunity Zones, what are the biggest takeaways that you see as that respects to Opportunity Zones? And also maybe share what you were hoping through the Opportunity Zones Working Group would be in the bill versus what was in the bill.
Sure. We saw a lot. We got a lot of what we asked for, particularly with permanence. Seeing the OZ incentive made permanent is such a great prospect for the long-term future of the incentive, so that folks can use it as a planning tool. It was sort of seen as a one-time great incentive, but it was expiring at the end of 2026. And so to see that made permanent for another round, they've been another round of Opportunity Zone designations, and then the investment into those areas that will follow is just fantastic. Something else that we really hope to see, and that we do see in the Opportunity Zones 2.0 legislation, was the rolling 5-year deferral period. So with the initial run of Opportunity Zones, everybody, no matter when you invested from 2018 all the way through now and through the end of 2026, you'd have a deferral of when the taxes would be due on that, but it all ended at December 31st, 2026, no matter when you invested. So for those early investors, it was great. They got up to an 8-year deferral before they had to pay their taxes. It was a great incentive, but it's become less and less and less. And now it's down to less than a year and a half of deferral. And so it doesn't have as much value. So seeing that 5-year rolling deferral period, so no matter when you invest, you get 5 years of deferral before any taxes are due on that deferred capital gain. So that was great to see. Again, at the end of that 5-year, you have an automatic deferral as long as you don't sell your investment. You get a 10% basis step on, meaning that 10% of the originally deferred gain is no longer, it will not be taxed. So you're only paying taxes on 90%. That incentive existed for the first round as well, but it hasn't been relevant for any investments made since December 31st, 2021. So that was an expiring benefit, which we won't have to see going forward, because it'll always have this rolling period at the end of which that basis step up will be allowed. So that's great to see. We also saw, we're seeing tighter eligibility requirements for what census tracts will be eligible for nomination and designation. In the initial round of Opportunity Zones, the limit, I guess the threshold that could be used to make a census tract eligible was if its median family income was 80% of its surrounding area or state. That is actually dropping to 70% is the maximum threshold now, which is, it's tightening the requirements. So needier areas are what are going to be eligible now to be designated as Opportunity Zones, plus the ability to designate census tracts that themselves were not qualified, but they were contiguous with the qualifying tract, which was allowed in the first round. That's also been repealed as a part of the OZ 2.0. And then really lastly, the other big takeaway, or a couple actually, there's some additional benefits for rural investments. And then there are also some long-awaited reporting requirements that were actually part of the original Investing in Opportunities Act bill 9 years ago now, that unfortunately had to be dropped due to budget reconciliation rules from the original OZ legislation. Well, there were some changes made this time around, and those reporting requirements stayed in through enactment. So we're very excited to see that. These were all things that the working group and other stakeholders in the OZ industry have been clamoring for now for a long time, and we're thrilled to see those added. You asked, what is it, and then we would have liked to have seen it. We would have liked to have seen some of this go into effect on the date of enactment rather than starting January 1st, 2027. And we'll probably talk about that more in a little bit. We also would have liked to see some exceptions made for operating businesses and affordable housing to make investments into those types of asset classes more feasible. We'd also like to see some integral gain treatment. Again, there's a number of things we would have liked to have seen. The House version of the bill called for subordinary income to be allowed, but that went away with the final version. So these are all things that we would still like to see that we think would make the incentive even more powerful, but aren't in there yet.
So tell me a bit about the mapping tool, as well as about the zones that are designated opportunity zones in Puerto Rico. And I will note to our listeners that, the intent of Congress is that the existing opportunity zones wouldn't expire until 2028, and the new zones would be effective January 1 of 2027. So in general, opportunity zones would be the new zone starting in January of 2027, and the existing zones would be good through the end of 2028, with one notable exception.
Yes. And so that notable exception is Puerto Rico. So about during 2018, early 2018, so shortly after passage of the Tax Cuts and Jobs Act, all the states and territories were starting to line up to make their nominations for their 25% of their low-income communities that could be designated as opportunity zones. And so they were putting these nomination lists together. Then they would send those on to Treasury. Treasury would then actually make the designation. That'll happen by June of 2018. The process was completed. However, Puerto Rico never went through that process because early on in February of 2018, legislation was passed that made all of Puerto Rico's low-income communities opportunity zones. They were all automatically designated opportunity zones. So Puerto Rico never actually went through the nomination and designated process with Treasury. What that means, though, with this new legislation, that special rule that designated all of Puerto Rico's opportunity zones, all of Puerto Rico's low-income communities as opportunity zones goes away, effective December 31st, 2026. So while all the rest of the country and all the territories will have sort of two sets of opportunity zones for 2027 and 2028, Puerto Rico, as it stands now, will be limited to just the newly designated opportunity zones that would be, we're referring to as the OZ 2.0 census tracts.
Great. Thank you for that. And if you want to talk a bit about the mapping tool, and you mentioned, as I did in the introduction, that the area median gross income maximum was 80%. Now it'd be 70%. And that's for purposes of determining areas eligible to be designated as opportunity zones, along with the poverty criteria. Since that means there are fewer areas, if 80% is the threshold, that's a certain number of census tracts. If 70% is the threshold, there'll be fewer census tracts, and you can select 25% of those, the governors can, which then means that there'll be fewer total opportunity zones under Opportunity Zone 2.0 versus 1.0. Maybe share your thoughts on how many fewer zones there'll be, and say a bit about the mapping tool. Then I want to move to a question on rural.
Sure. It's a significant projected decrease in the number of opportunity zones that are expected under 2.0. Under 1.0, there's 8,764. The drop, the reduction because of that lower threshold being used is expected to be somewhere between 20 and 30% of the total. So we're looking at 6,500 to 7,000 opportunity zones under 2.0 versus the 8,764 under 1.0. And so you mentioned the mapping tool. This is brand new. I think we actually published this last week. As much as I would like to talk about it, I think it'd be even more effective if I showed it.
Please do. We don't usually have video. Those that are listening to the podcast, this might be one where you want to jump on YouTube.
Yeah, at least for this part. So Mike, can you see my screen okay?
I see it wonderfully.
So what we've done is we've worked to identify census tracts that are expected to be eligible for nomination and designation. It does not mean that they are or will be opportunity zones. This just means that they are under the most recently available American Community Survey census data would meet that 70% threshold, or a second way that it can qualify is if its poverty rate is at least 20%, and as long as its immediate family income is less than 125% of the surrounding area. So there's two different ways to qualify, and that's what this map shows. Everything that's in green means that it is going to be eligible. So green, this orange color, or this purple color all indicate. But what we've done, and we'll talk about this more in a moment, what we've done is we've also tried to identify areas that are going to be considered rural. So we'll go into that discussion a little further. What this mapping tool allows you to do, when you first open it up, it's going to open up with looking exactly like this, where the areas that are in this sort of light orange color are not eligible. Everything else that's green, orange, or purple are at least eligible for designation. This map tool is great because you can put in address, city, county, zip code, latitude, longitude, if you happen to know that information about where you're looking to invest. Those are all available options to help you narrow into an area and see what's available. So say if we wanted to look in Dallas, Texas, we can zoom in on Dallas, Texas, and we can really see what census tracts are potentially going to be eligible. This is going to give investors, this is going to give economic development groups within these states the ability to get an early peek, we think, of what areas may be eligible and start making some plans for that. So this is proving to be very popular, and we'll discuss more of the rural features here shortly. But once you get in, you can then click on the census tract. It's going to bring up additional information, letting you know what percent poverty, which is one of the two criteria, and the percent of median income that census tract has, and then you can compare that to what the rules are. So if it's really, really close to what those thresholds are, it might indicate it is less likely to qualify once newer census data comes out. We expect there's updated American Community Survey census data that's due out in December. That's going to run for the period of 2020 to 24 of 2023. That 5-year period is the most recent available now. We expect there to be one more forward year available prior to this whole nomination designation process starting. We do think it's possible that, similar to the first round of opportunity zone designations, governors may be able to choose from both sets of data. So using either the 2019 to 2023 or the yet to be released 2020 to 2024 American Community Survey data. That was allowed in the first round. It may be in the second round, and we would probably recommend that just because that gives folks more time to be able to start making plans as to what makes sense and where they want to focus their efforts.
And just to be clear and maybe level set, these are the areas that are likely to be eligible for nomination. And then the governors can select 25% of the eligible once Treasury comes out with the list of what zones are eligible for nomination based upon more recent data. And then the governors will nominate 25% of those. And then the Treasurer will then likely approve those nominations and then to become opportunity zones effective January 1 of 2027. Do I have that right?
That is exactly right. That's very, very important to note that just because it's purple now does not mean that it's going to be designated. Governors are going to be limited to 25% of always purple, or the maximum that can be designated within any single state.
And then you say likely, eligible, and that's based upon current census data, and you don't know what the next round might be or the next updated. Then you also say likely rural or likely not rural, because similarly, it's not entirely clear how the rural designations themselves will get made. But maybe talk about the significance of rural in the updated opportunity zones, what we're calling opportunity zones 2.0.
Right. No, there's definitely a focus on trying to direct more opportunity zone investment to rural areas. The rural areas did not receive the level of investment that was expected, I think, from the first round based on the number of opportunity zones that were designated as rural. So urban areas saw it disproportionately high. So there were some additional benefits to investors built in to the Opportunity Zones 2.0 legislation. First is that I mentioned earlier that at the end of a 5-year hold of a qualified opportunity fund investment, 10% of the capital gain is tax-free. Well, if the investments are into rural areas, triples to 30% of the originally deferred capital gains no longer taxed. That's a pretty significant benefit. Another benefit that's in place actually now is that properties in used property that's acquired in a rurally located opportunity zone are subject to a reduced substantial improvement test. So if you buy property that's been in use by another taxpayer before, in order for it to qualify under the existing opportunity zone rules, the old, we'll say old at this point, you had to at least double your basis in the property. So if you bought it for $1 million, you had to spend at least $1 million in order for the property to meet and be qualified under the OZ rules. Well, that's cut in half for properties that are located in rural areas, meaning that same $1 million property, you have to spend $500,001 rather than $1 million. The intent of that is to make it easier for acquisition rehab type projects to happen in these rural areas. So go ahead, Mike.
No, I was just going to say, I will note that roughly 8.5% of the investment dollars by a study that's several years old showed 8.5% going to rural areas, which is, if you think the amount invested is over $100 billion, that means over $8 billion did go into rural areas. So it's not as if the rural areas weren't getting investment, but go ahead and finish up here. And then I want to move to reporting.
Sure. So just, sticking with the mapping tool for just another moment, what we've layered in here is using it's actually a USDA definition of what is a city or a town with more than 50,000 inhabitants. And that's what the rule is. A rural area, for the purposes of opportunity zones, is any area that's not a city or town with greater than 50,000 inhabitants or adjacent or contiguous with a city or a town of 50,000 inhabitants. So back to our mapping tool, we currently have the potential low-income communities selected. Under this new map tab, we can click on cities and towns with more than 50,000 people. I want to zoom out, get a larger area. This indicates the boundaries of all the cities and towns that are greater than 50,000 people. So if your census tract that you're interested in is located wholly outside and doesn't touch that area, it's in green. Green means it's eligible for designation and it's likely eligible, and it's also likely to be considered rural. Okay. Purple means that some or all of the census tract is located within a city or a town of greater than 50,000, so it's likely not going to be rural. You'll see a handful of orange, and this is where we're going to need some guidance, particularly because that rule is that any urbanized area contiguous or adjacent to a city or a town is also not qualified. We don't know what that means. There's no definition for urbanized anywhere. We don't know if that means the entire census tract would not be eligible, or would it be just the strip that borders the city or town would not be eligible. So we'll need guidance around that. But that's how to use this map. This map it's for informational purposes, and it's meant to help to identify areas that will be eligible for designation and that are or are not considered rural.
Great. Thank you for that. Thanks for sharing your screen.
Sure.
I wanted to turn now to the reporting requirements. And I know you'll go into the reporting requirements in more detail during the webinar. And I suspect the reporting requirements will be something we talk a reasonable bit of time on at our conference, on our Opportunity Zone Summit in Las Vegas in December. But if you could just give a real quick overview on reporting requirements that are now enacted and are part of the code.
Sure. So there are a few additions. It's not an exhaustive amount of additional reporting, but there are a few additions that we think are going to be very helpful into really tracking what Opportunity Zone investors and investments are accomplishing. So in addition to currently, you're required to, as a qualified opportunity fund, you're required to list out the taxpayer ID, the amount of investments into an Opportunity Zone business, both of those things, as well as the amount of tangible property that an Opportunity Zone business owns. In addition to that, you're now being required to report the name and address, also the type of business, using the North American Industry Classification System, which is that's what's on like page 1 of a partnership tax return. It lists that information. There's also the number of residential units that were built, if any, if it's any type of residential development, and also the number of full-time equivalent employees of the corporation or the partnership for the year. So that's the new information that's going to have to be listed. It's not a lot. However, failure to do that does result in some fines. There are fines written in now to the code. So failure, and they're assessed daily for not providing the information. So if it's a smaller fund with less than $10 million in gross assets, it's up to a maximum of $10,000 per return, assessed at $500 per day. And then if it's a larger, a greater than $10 million off, that penalty increases up to a maximum of $50,000. And then it gets even worse if it's intentional. If it's intentional disregard, those are all multiplied by 5. So it gets to be pretty expensive if you intentionally don't provide this information as now required. And then what's neat about this is that what's going to be done with the information is that starting as soon as possible after enactment, and then annually thereafter, the secretary is going to be required to provide public reports that list out the number of funds, the average or the total amount of investment assets held by the funds, investments by that NAICS code I mentioned, a percentage on Opportunity Zones that are receiving investment, which is great news, because best case now, as Mike mentioned earlier, we're at least 3 years behind as far as the latest data that's been made available to us. So it's really hard to see what has happened in Opportunity Zones with the incentives. So I think all stakeholders are excited to see this information coming.
And when did the reporting requirements take effect?
They take effect next year.
Thank you. So now let's talk about the timeline. I mentioned earlier briefly the designation of the new zones and the timeline, but if you could be a little bit more pedantic
That I can.
discussion. And once again, I know, this will be a really hot topic at the Opportunity Zone Summit in December, particularly, because we'll be that much closer to Treasury kicking off the designation process.
Sure. And I think it's interesting the additional time that governors are being given before this designation process kicks off. With the Tax Cuts and Jobs Act, which passed in December of 2017, a month later, governors were starting to be tasked with putting this process together. No one had any idea what the Opportunity Zone incentive was going to mean and how the best way to go about designating. Now that we're 8 years past that, there's some time. The nomination process doesn't start until July 1st of 2026. So that's 11 months, um, 10 and a half months from now. So there's a lot of time.
Accountant.
There's, there's a lot of time for the governor's offices to really prepare and to really do some deeper analysis, I think, into what census tracts are going to make sense for them to nominate. It's important to find and locate census tracts that are going to be developable. Some census tracts just simply aren't for various reasons. And so it's going to give, I think, states and territories a lot more time. So like I said, the nomination process starts July 1st, 2026. Governors have up to 90 days plus a one-time 30-day extension. So a total of potentially of 120 days to make their nominations. After those nominations are made, Treasury then has 30 days, subject to an additional 30-day extension to actually designate the census tracts to be opportunity zones. And so what's interesting about the timing here is that whenever Treasury receives the nomination from a state, it has 30 days up to 60 days to nominate. So you could potentially have states that use the next 10 and a half months to start preparing and perhaps make their nominations pretty early on in that maximum 120-day window. So Treasury might need to start making their actual designations pretty soon after that.
Right. And that whole process gets kicked off in a serious way when Treasury releases a list of tracts eligible for designation. And I'm not sure we know the timing quite yet as to when Treasury might release that, but it's certainly not the highest priority in the near term.
We don't know that yet. We don't even know what data set they're going to use yet to base that on.
But like I said, there'll be a discussion about that at the conference in Las Vegas. And then there is this 2-year overlap. If you want to sort of restate what I said earlier for those with a little bit more nuance as well, how we'll have this period of time with sort of extra opportunity zones, if you will.
Sure. So that total 180-day process that we talked about for the nomination designation, that's designed to have the Opportunity Zones 2.0 census tracts in place January 1st, 2027. However, the Opportunity Zones 1.0 census tracts maintain their designation through December 31st, 2028. So it's expected that there's going to be a 2-year overlap in which investments can be made either in Opportunity Zones 1.0 or Opportunity Zones 2.0 designated census tracts.
And I certainly think it's clear that that's what Congress intended when they wrote the statute, to have this 2-year overlap. And I know one of the areas where the Opportunity Zones Working Group is seeking guidance from Treasury, and not just seeking guidance, suggesting how the Treasury should view certain situations. One is what happens when an Opportunity Zone expires. And as we discussed before, getting guidance on Opportunity Zones, what happens when they expire to existing businesses. December 31, 2028 will be here before we know it. So we want to know what happens when those zones expire. But with Puerto Rico and its zones expiring at the end of this year makes that guidance even more important. But that's clearly something that I think everyone out there in the Opportunity Zones world wants to get better guidance on. And we have in the past worked in developing language as to what type of guidance we think would be useful, which I know we'll be submitting a letter to Treasury, including that recommendation. But what are some other areas where the Opportunity Zones Working Group is seeking guidance from Treasury? There's lots of areas where we'd like to have guidance, but there's some guidance more important than others and more needed more quickly. Clearly, Puerto Rico needs this issue about expiring zones and what they should do in terms of nominating a subset of zones. But what other areas of guidance are you thinking is really important to get in the near term?
Right. The Puerto Rico and then just overall transition guidance in general. There's so many questions about how long can I continue to invest into an existing project? What if I'm constructing a project that I'm not going to have done before the zone expires? What does that mean? And so there are so many questions that we're receiving on a daily basis that's critical. Some rules around defining what's exactly meant by these rural provisions, because some of that substantial improvement benefit, that reduced substantial improvement to 50% is in effect now. And no one's really sure how to take advantage of it or what that means. Does it only apply to property acquired after enactment? Does it, et cetera? There are so many questions around that. Exactly what's going to qualify.
Right. I was going to say, I know that you're going to be talking about this more on the webinar, and it's something that is a ongoing work stream for the Opportunities Working Group. And that's one of the interesting things that you mentioned about all these various questions to ask and more keep coming up every day. That's one of the good things about the Opportunities Working Group is we get to talk through issues we've identified. And we also get to be faced with questions that hadn't been identified yet, but someone's actually dealing with, and we end up surfacing it in the Opportunities Working Groups. We kind of share that. And that's one of the areas I'm always the most nervous about, not the issues I know about. It's the ones I don't know about yet.
That's what's great about the Opportunities Working Group, is that there are so many bright practitioners that participate. And so we're crowdsourcing constantly to find these questions. And we receive very regularly, okay, so I'm a member of the working group and I have a client that's dealing with this issue, or how do I approach this? And then we're able to really work together and come up with consensus solutions on how to deal with them. So it's really been impactful, I think, for the OZ industry as a whole. Our work.
Yeah, it was interesting because at the very beginning of Opportunity Zones, one of the key areas that the Opportunities Working Group serve was if folks were moving forward with investments with a lack of guidance and you wanted to be pretty much down the center of the fairway, but you weren't quite sure which fairway you were on. It was good to develop consensus interpretations. So at least you knew you were traveling with the pack or traveling with the herd and not having an interpretation that was an outlier. And I think it served all the members very well. I wanted to turn now to the tracking of qualified opportunity funds. We track funds, and every quarter we give a report as to the fundraising, other specifics of the funds that we track. We think that we're capturing roughly a third of all funds. So we think that the actual market is well over $100 billion. Please share your thoughts on our recent reports. I know you've blogged about it a lot, and then also speak a bit about this so-called dead zone that's going to be coming up in 2026.
Sure. So as far as our quant survey, as you mentioned, we quarterly, we survey thousands of qualified opportunity funds. And with that data, we've been able to track about a third, we think, of the overall data through June 30 of 2025, so second quarter. We have now tracked over $42 billion of total investment, which extrapolates, as you noted, out well over $100 billion of total investment. And we've actually seen an uptick in 2025 over 2024. In fact, we were over $1 billion of investment in second quarter of 2025. It's our second largest quarter over the last 2.5 years. And the first half of the year has been the best half year since early 2023. So we're excited to see that despite to that point, the Opportunity Zone Incentive sort of approaching its end, which was previously going to be December 31st, 2026. Now it's extended, of course, but we are happy to see that investment is continuing. You asked me to talk about the projected dead zone.
Yes.
As I noted earlier, one of the asks that we had was to see some of the benefits go into effect immediately upon enactment and not at some future date, because we were concerned that if the benefits were at a future date, investors would be incentivized to wait to make their investments until that future date. And that's sort of exactly what's happened. The additional basis step up, the 5-year deferral, that's only available to investors that invest on January 1st, 2027 or later. So any investments made between now and the end of December 31st or the end of 2026 are only going to be deferred until the end of 2026, and they won't be eligible for any basis step up. Whereas if an investor is able to time or impact the timing of their capital gain event, such that they can wait to make their investment in early 2027. They'll be eligible for all these additional benefits. So we think while there will be activity between now and 2026, it's going to be less and less as we get closer and closer to the end of 2026, because those capital gains will just simply be eligible to be invested in early 2027.
And just to be a little bit more specific, if you're a calendar year taxpayer and gains are being recognized in 2025, be it individually or inside a partnership that's also a calendar year, those gains would have to be invested by the end of 2026. And if you are an individual recognizing gains in 2026, then if they're recognized in the last half of the year, for the most part, you could defer your investment until 2027. And if it's recognized through a partnership, then you would have the ability to not have to invest the gains until 2027. Anything else you want to say on that rough overview?
No, I think that sums it up. It's just there's going to be plentiful incentives to be able to wait until 2027 if investors can.
Right. And it's basically gains in 2025 can't wait. Most gains in 2026 will be able to wait. As a consequence, we expect that on balance, it will wait, which is why we're talking about this dead zone next year, where investment levels will decline, and then there'll be a huge rebound effect in 2027. So with that, and there's so much more we could cover, and I know you're going to cover so much more in the webinar. That's, as we mentioned, the day after this podcast posts, but that webinar will also be recorded. So if you're listening to this afterwards, it's not too late to watch a broadcast of it. We've talked about the updated mapping tool, and thank you for that walkthrough. And then I've also mentioned we have the OZ Summit coming in December. We hope to see everyone there. And if you have areas that you think it's important we particularly address, then please email Jason or me or cps@novoco.com. And I will include information about joining the OZ working group. And I encourage anyone working in the opportunity zone space to become a member of that group. If for nothing else, have someone in your team become a member or just have them listen. I have no doubt there'll be issues and information they gain from it that'll more than pay for the membership and their time spent participating in the calls every month. Anything else you want to say, Jason, or did I kind of sum it up well?
No, that's great. Like you mentioned, the working group is a great way to have your voice heard and to be at the table as these discussions about what kind of guidance is necessary are being talked about over the next 4 to 6 to 8 to 12 months.
So do stick around. Thank you for joining me, and stick around for the off mic section, Jason. To the audience, if you have questions or want to know more about opportunity zones, I encourage you to reach out to Jason. I will include his contact information in today's show notes. I'll also link to the variety of other items that I mentioned during the course of the podcast in the show notes. I also want to encourage you to consider subscribing to Tax Credit Tuesday. Not only consider subscribing, actually subscribing to Tax Credit Tuesday, or whatever platform you get your podcasts. And if you're watching on YouTube, I also would like to encourage you to like and comment on the video to help raise its awareness. Then lastly, please do share the podcast with colleagues. It's a great way for you and your colleagues to learn more about the various incentives we cover. And we definitely we hear stories of people who will hire somebody and they'll say, go binge watch or binge listen to these 5 or 6 podcasts to get a little bit more up to speed and at least learn a little bit more of the vernacular and language of these various incentives. So thank you. So now let's turn to our off mic section, where we use this space to give a shout out to others working in the tax incentive community, an opportunity to highlight a professional worthy of recognition. Jason, who would you like to shout out?
I'd like to shout out Jimmy Atkinson. Like we all know Jimmy, he runs OpportunityZones.com. He also has a standalone Opportunity Zones podcast. Jimmy's been a fantastic advocate just for the OZ incentive, and just want to thank him for all of his efforts.
Great. Thank you for that shout out. I echo your shout out. Jamie Atkinson has been there from the very beginning, a true believer in the importance of tax incentives to create stronger communities, particularly in distressed areas, and appreciate his focus and the great work that he does in the opportunity zones area. So thank you, Jimmy. And Jason and I have been frequent guests as well. So thank you for bringing the podcast today, Jason. I'm looking forward to both the webinar and the Opportunity Zone Summit, which will be both timely from an information perspective, but also a great time to celebrate permanency of opportunity zones. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.